Our guest is bullish on emerging markets, and he says relative underperformance by US stocks is pretty similar to what happened in Trump's first term. We're joined by Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, always great to see you. Thanks very much indeed for joining us. Just remind us, so stocks were under pressure during Trump's first term as well?
Yeah, that's right. So look, nothing appears safe this morning, but stocks in key EM markets, emerging markets like India and China, are actually down less than 1% today, offering a relative safe haven. But yeah, if you think back to 2017, Trump's first term, we saw very similar outperformance by emerging market stocks, despite all the uncertainty. Back there in 2017, we saw emerging market stocks really dramatically outperform U.S. stocks, not just in the first quarter, but the second quarter, the third quarter, and the fourth quarter as well. And part of the reason for that was we saw better global economic growth in 2017. I know that seems like something maybe not on tap for this year, but if you look just back to the OECD's economic forecast just released, last Monday, better economic growth in Europe, the UK, in Australia, in Japan, many countries around the world this year, even as the US is slowing. So if we see that economic momentum continue to improve, although marginal, that should help to lift EM stocks, which are sensitive to economic growth. And then finally, just on the April 2nd tariffs, emerging market stocks are less a target of these tariffs. We've already heard about the China tariffs. They're priced in. India may not see many tariffs because we don't get a lot of manufactured goods from India into the U.S. So they might be a little bit insulated from the news this week, and clearly aren't big makers of pharmaceuticals or semiconductors targeted by the Trump administration. So again, they might offer a safe haven for investors here.
So just to clarify, it was you're mainly talking about emerging markets beating U.S. stocks during Trump's first term. Right.
That is correct, yes.
Thanks. So tariffs obviously could be inflationary. Does that change your view? It's not clear, of course, how sustained that would be. Does that change your view on the U.S. market?
We're somewhat cautious on the U.S., expecting volatility here. Obviously, no one really knows what's going to happen tomorrow, at least according to reports, maybe not even those in the Trump administration. And so there are certainly concerns in the near term that would bolster inflation, keeping the Fed on the sidelines, making those expected rate cuts by many in the markets, maybe 2 more rate cuts this year being priced into interest rate futures markets, seeming unlikely to us. We think it's far more likely we'll see other central banks around the world continue to cut rates, which support their valuations. At the same time, the Fed is kept on hold by this tariff uncertainty.
Talk to us a little bit. You touched on European stocks here. Do you think they offer decent value right now? I know that's a very broad brush question, but are you attracted by Europe?
I'm a big fan of European stocks. We've talked about them all year in our outlook for 2025. Europe was our favorite market. And one of the reasons for that is clearly more fiscal spending and spending tied to defense in Europe, helping to bolster their economies. But also, a consumer that was really had their back against the wall. They're starting to spend a bit more. Obviously, the stocks were much more attractively valued. All that's coming into play. What's interesting is those companies within Europe that have European continental sales exposure, meaning they're more domestically focused, seem to be doing really well here in Q1, as opposed to those that have more US-based sales. And that might be something that continues. In fact, there's a big gap. Those companies within Europe that are more focused on US sales are down 3% this month, whereas those focused more on continental European sales are up 3%. So that's one way to think about investing. From a sector perspective, that would mean stocks like utilities and industrials and energy and more consumer-oriented stocks within Europe, as opposed to those more maybe tech-oriented shares and non-finance companies that are a bit more focused on U.S. markets.
Jeffrey, have you ever in your career seen such uncertainty as we're in right now with these tariff threats?
Economic uncertainty, no. And in part, it's simply because we just really don't know what's going to come out and whether it's going to last or whether it's going to immediately be rolled back. So there is a tremendous amount of uncertainty here. In general, when investors are confronted with uncertainty, they want to concentrate on a few things that they know. It's far better to diversify now. There are many markets around the world that are performing very well. So broader exposure across sectors and across markets around the world may be a better bet than just focusing on 1 or 2 ideas within a portfolio. Broader diversification tends to pay off when uncertainty is high.
And what about resources? I don't know how granular you get, but say, would you be a buyer of energy stocks right now?
I think energy makes some sense. Sure, there are economic risks, and as the global economy slows down, there may be less demand for energy. But if you look longer term, I think the sector looks very attractively valued. Oil prices this morning, in the U.S., $69.75 seems at the low end of the range. So I would say there's probably more upside to oil prices over the next couple of years, and certainly consumption, I think, as well, combined with still a fairly constrained supply environment. So I think energy looks good, particularly with most of the world's economies accelerating this year outside of the US and China.
Always great hearing from you, Jeffrey. Thank you very much.
Thanks for having me.
Jeffrey Kleintop of